Are you planning on turning your American nightmare of financial uncertainty into your own version of the American dream? Well, here's the scoop. Investing is the key, but hold on. It's not just about throwing money at things. It's about strategic moves for potential rewards. Warren Buffett, the guru of value investing, has some golden nuggets on this. Join us in unraveling the mystery of wealth creation for retirement. In this video, we're diving into Warren Buffett's playbook to unveil the 7 indispensable investment types you need to know. Hit that like button and subscribe to our channel to make sure that you don't miss out on mastering your financial future. For now, let's begin. Number 1. Unique investments. Ever noticed how the wealthy love collecting watches or owning luxurious bags that everyone wants? These items are in high demand with limited supply, making them valuable investments. Warren Buffett advises diversifying your investments across various uncorrelated assets like wine, rare watches, or antiques. This strategy involves spreading your money across different types of investments, from stocks to real estate, to reduce risks. Some folks worry that diversification might reduce their investment returns, but here's the thing. In investing, it's not just about high returns, but about getting the most return for the least risk. Number 2. Oil stocks. Buffett's interest in oil stocks like Occidental and Chevron isn't solely about predicting short-term oil price movements. He believes these companies will benefit long-term. He sees potential in their approach to managing money, with less spending on new oil exploration and more on rewarding shareholders through dividends and buybacks. This strategy hints that oil prices might stay high because companies aren't aggressively expanding oil exploration. It's essential to note that Buffett's investment in oil stocks doesn't mean he's betting on rising oil prices. He once said, "We invest if we see value, not necessarily because we predict price movements." Number 3. Treasury Bonds. When it comes to low-risk investments, Treasury Bonds are the go-to choice for many seasoned investors. These bonds are essentially loans to the US government and are regarded as the safest investment in the market. What makes them so secure is that they are backed by the full faith and credit of the United States government. One of the primary advantages of Treasury bonds is their status as a risk-free investment. Due to their backing by the government, they are considered to have minimal risk of default. This security makes them an attractive option for investors seeking stability and a guaranteed return on their investment. Another noteworthy aspect is their tax benefits. Treasury bills are exempt from state and local taxes, unlike some other saving options like high-yield savings accounts or certificates of deposit. This tax advantage means that investors can effectively boost their overall rate of return by not having to pay taxes on their gains to state or local governments. Moreover, these bonds are highly liquid assets. They are easily tradable in the market, almost as flexible as cash. The treasury market is vast and active, allowing investors to buy and sell treasury bills swiftly. However, this liquidity comes with a caveat. Selling them on short notice might result in a loss, as their value can fluctuate based on market conditions. It's important to note that while treasury bonds are incredibly safe, they typically offer lower returns compared to riskier investments. The trade-off for the security they provide is usually a lower yield. For some investors, the lower potential return might not align with their investment goals, especially if they're seeking higher growth. Warren Buffett has often highlighted the importance of understanding the trade-offs between risk and return. While treasury bonds offer security, they might not be the ideal choice for those aiming for higher returns. Buffett's investment philosophy involves considering these trade-offs carefully and making informed decisions that align with one's investment objectives and risk tolerance. Number 4. Blue chip art. Have you ever thought about how the affluent safeguard their wealth during economic downturns? Enter blue chip art, the discreet yet powerful investment avenue. It's akin to a rare treasure coveted by collectors and connoisseurs alike. When times get tough, the wealthy often turn to art as a secure investment. Surprisingly, the art market has consistently outperformed the stock market for the past quarter century. But what's even more fascinating is that art tends to hold its value even in times of inflationary pressure. But why should one consider diving into the world of blue chip art? For starters, it's a colossal industry valued at over $1 trillion and continuously expanding. Investing in art is unlike the conventional avenues of stocks, bonds, or cryptocurrencies. It's a sophisticated and specialized asset class. Imagine those multi-million-dollar masterpieces quietly adorning the walls of luxurious estates, stealthily acquired through enigmatic dealers. A substantial part of this trillion-dollar art market operates behind closed doors. Now, if you're not among the elite 1%, you might wonder how this world works. That's where platforms like Masterworks step in, democratizing high-end art investment. They slice the ownership of a painting into shares similar to stocks, allowing fractional ownership accessible to everyone. This trend of fractional ownership is revolutionizing the art scene, offering inclusivity without requiring a hefty minimum investment. Additionally, these platforms provide insights into art trends, unveiling the profitable potential of the art market to the broader public. Number 5. Emerging markets. Ever thought about investing in countries on the verge of economic transformation? That's what emerging markets are all about. These markets encompass nations on the cusp of significant growth and development, while big players like Brazil, Russia, India, and China often grab the spotlight. There's more to explore in their neighboring regions. Take Turkey and Georgia, for instance. Despite uncertainties in certain areas, other parts are teeming with possibilities. Imagine snagging a seaside one-bedroom apartment for a mere $35,000 or investing in hotel rooms in Butami, Georgia, yielding an impressive 12% annually, all within a $100,000 budget. These emerging markets boast hidden treasures for savvy investors, even in popular tourist havens like Thailand or Indonesia. Lesser-known spots hold immense investment potential. It's akin to witnessing the transformation of once overlooked areas that, like the Australian coast in the 1950s, are now setting real estate records. Number 6. Passive business investments. Diving into passive business investments can be a game changer for generating income without the need for active management. Take Warren Buffett, for example, a seasoned investor who excels at pouring funds into successful businesses without getting involved in daily operations. The crux lies in establishing revenue-generating systems that operate without constant oversight. Imagine creating digital products like ebooks or online courses that generate continuous income, allowing you to earn even while you sleep. But what if you lack the time or resources to initiate a business venture from scratch? Don't fret. Investing in existing businesses owned by others can also be a viable option. Building these passive income streams demands dedication and patience, but they stand as pillars of financial stability. Number 7. Index funds. Warren Buffett, revered for his stock-picking prowess, advocates a distinct investment strategy for the majority: index funds. These funds represent a diversified basket of investments mirroring the entire market, providing investors with exposure to various segments rather than individual stocks. They come with low management fees, simplicity in construction, unlike relying on single stocks where the failure of one company could severely impact returns. Index funds spread risk across multiple companies. Studies consistently reveal that most portfolio managers struggle to outperform the market over time due to emotional trading. In contrast, index funds offer stable and reliable returns, making them a prudent choice for many investors seeking long-term growth without the complexity of managing individual stocks. And that's a wrap for today. Exploring emerging markets brimming with potential to uncovering the secrets of passive income through business investments and understanding the stability offered by index funds, we've covered a lot. Now, here's a question for you. Which investment strategy resonates with you the most? Are you intrigued by the prospects of emerging markets or considering passive income streams? Remember, the journey to financial prosperity involves informed decisions and continuous learning. Don't forget to share your thoughts in the comments below. Now, if you found this video helpful, give it a thumbs up and hit the subscribe button to join our community. But other than that, thanks for joining us today and we'll see you next time.